Hello, everybody. I'm Chris Southworth, Secretary General of the International Chamber of Commerce here in the UK. Welcome to our Talking Heads videocast series. Today, I'm talking to Martin McCann, the CEO of Trade Ledger, all about trade finance, working capital. How do we help drive growth and support SMEs? What are the issues? So, hi, Martin. Thank you for joining us today.
Hi, Chris. Nice to be here. Thanks for the invite.
Our pleasure. Can you just tell us a little bit about Trade Ledger for those that don't already know? What do you do? What is it there? What are the services that you provide, and what sort of role do you play in the global market?
Yep, certainly. So my background is enterprise technology. That's what I've done for the last 25 years. And really, I started Trade Ledger in 2016 with a single purpose, and that was to provide sort of enterprise tech and data services to help the financial sector to unblock the flow of working capital to growth companies. And specifically, the reason why I chose that purpose is it felt like something that needed to be done to help to sort of rebalance the system, to help us to all figure out how to make businesses more of a force for good by providing the capital that they need. So that the people who run them, who want to have an impact in the world, actually have the resources to follow through with that mandate. So we're a technology company, and our customers are both banks and non-banks. Mostly we have been lucky to sign up some of the world's largest banks. So customers like Barclays, HSBC, and a bunch of others.
Yeah, and you talk very eloquently about working capital versus trade finance. ICC tends to focus a lot on the trade finance and the trade finance gap, but I think it's a very important difference, isn't it? Particularly when we're talking about growth. Can you just tell us a little bit, what's the difference between trade finance and working capital, and why is working capital so important in terms of driving trade and growth?
Yeah, it's a great question, and it is something I feel passionate about. And I think it's an advantage of sort of tackling this sector from like a non-bank background. It's the difference between what companies need and the products that bank provides, essentially. So in my view, trade finance is a particular specialist product sector of the working capital market. So it's a subsector, it's a product specialism. But working capital is basically providing all of the cash that a company needs to fill the if you like, the order to receipt of cash gap. And in reality, it requires a number of multiple different bank products in order to fund that gap, because there's quite a big time lag between receiving an order as a company, delivering the service or product, and then actually getting paid. And that's all often sort of more than 3 months, where essentially the company providing the service is expected to be the finance provider to finance that transaction until such times as it's complete. And what we're finding is that the problem that businesses are thinking about is that sort of working capital for the cash to cash cycle along that timeline. And what banks provide is specific specialist products which form part of that solution. And that's one of the problems, I think, in the industry, is that the banks talk in terms of products, and the businesses think in terms of the working capital requirements and needs. But there's a bunch of other products as well as trade finance. It is the biggest subsector, but there are other sort of secured asset-backed lending solutions, such as equipment finance is a good example of that. Commercial mortgages are often used for working capital solutions. And at the smaller end of the market, it tends to be unsecured solutions, such as overdrafts and card services, because those are the only products typically that smaller companies can get access from banks to provide credit for working capital.
It's quite interesting, isn't it? When you talk to SMEs, this really resonates a lot with me. When I talk to an SME, that they don't really sort of either know what trade finance is, or certainly don't differentiate it. All they want is where's the cash in order to then fund the deal or whatever they're doing. It's quite interesting. It's almost a sort of finance perspective versus a customer's perspective from the other end, isn't it? I think working capital resonates a lot more with me. Certainly as running an organization too, it is all about working capital, isn't it? Can you just tell us a little bit about the numbers? Because you've quoted to me before some pretty large numbers. The ICC says there is a trade finance gap of 1.7 trillion worldwide, which is a pretty large number anyway, but you quoted much bigger figures on working capital. Could you just explain what those figures are?
It's quite difficult to figure out how you want to draw the boundaries around the working capital market. But if you look at it sort of nuts to bolts for everything from SME to very large corporates and all product types, the amount of capital deployed by the financial sector to fund businesses is somewhere in the region of 20 trillion USD. And the gap in terms of the amount of demand that's unmet is somewhere between 3 and 5 trillion USD currently. And the expectations is that demand is going to continue to grow. So by 2030, it's expected that there'll be need for another 10 trillion USD of working capital sort of financing, credit, or other solutions like early pay, for example, in order to help businesses to optimize growth and employment and the impact and change that they can have.
And these are global figures, aren't they?
Yes, they are. And it's quite interesting. It's such a heterogeneous area. It's very difficult to come up with consistent numbers. So the ICC's numbers, very reputable and sort of look at a very specific sector of the market. But it's not the total number. So, there's boundaries around that. And if you look at everything put together, the best we can estimate currently is from the reputable research sources we've seen, including the ICC, is that actually the whole market is bigger, because most people think of large corporate and institutional financing, for example, as being separate to sort of working capital market, whereas we look at it all as one, because the only difference really as you get bigger is whether or not your main requirement is the cash-to-cash working capital cycle, or if you like, optimization of your balance sheet and the use of other sources of capital for treasury and liquidity solutions. That's the only real difference, is the problem statement is different. But the need for working capital credit or liquidity credit as it transforms into the large corporate sector is pretty much the same. So we sort of look at it the whole way, which is why our aggregated number from sort of primary research is bigger.
Yeah, it's really interesting. Let's talk a little bit about the barriers, because those are important. What is it that's stopping the access to working capital, in your view?
Yeah, it's quite interesting. I mean, business and commercial banking has really been designed around sort of large corporates. That's really where the need came from in the first instance. And for the longest time, small business banking was loosely based around retail or personal banking. And I think fundamentally that sort of segmentation has sort of persisted to create the problems that we have today. So most of the products and services you see in sort of corporate banking as a specific sort of sector of the financial sector that services working capital, because there are non-banks as well. They're really designed to appeal to companies with large amounts of turnover and employees. So you can think, companies with certainly more than 10 million of turnover. I'd say the majority of those services in the most profitable sectors for those banks are companies with more than 50 million USD of turnover. And we're a good example of that. I mean, we're a small, growing, still unprofitable business, because we're creating a new market. So we consume equity, we raise money from investors, but we have limited access to bank products, particularly credit products. So the only facility that we're able to get is an unsecured overdraft, which is a small proportion of the overall working capital needs that we have. And equity tends to be the only way that a company like us can actually invest in order to grow. I think the real problems stem from the fact that if you look at how products and regulation was designed, it was designed around certain assumptions which only apply to large corporates. So credit assessment, decisioning, etc. They all work around sort of file statutory accounts and the shape of sort of financial statements that are persistent in sort of companies that have been established for a longer period of time, are profitable, and have certain other attributes.
And you've talked about sort of the role of regulators and government here in policy, particularly regulators, and also technical as well. Can you just explain a little bit more about what you mean by issues with regulators? What are the regulators not doing that they should be doing in order to improve access to working capital?
Well, I think everybody has the right intent, and there's lots of good initiatives going on, but they don't seem to be getting knitted together to come up with I guess more radical change. So I think it's revolution that's required rather than evolution in order to address the size of the problem in terms of flowing working capital into growth companies, which tend to be mid-market and SME companies on the smaller side. So there's some really interesting initiatives going on. So most of the regulators in the large markets around the world have come up with these concepts of sandboxes. But the problem is that the banks are not entirely sure what to do with the sandboxes. So we speak with some of the regulators, like the UK regulator, Hong Kong, sometimes the US, and there's certainly an appetite to do more in order to create sort of innovation to unblock the flow of working capital. But there's not really a clear written sort of strategy, I think, for the industry as to what the rate of innovation is that's appropriate, what level of reinvention of products would be required in order to unblock the flow of capital into growth businesses to help stimulate sort of economic growth. So everybody's got the right intentions, but everybody's got their day job, if I put it that way. And the regulators are most interested in sort of bank stability and continuing to ensure that the flows of capital that support economic growth and society don't get affected. That's kind of their role in this. So it's a different set of skills, I think, that the regulators and the bank need to have, in a different set of conversations in order to think outside of the box. And those conversations have happened sort of piecemeal. But my sense is that there's no industry level sort of guidance written down as to what rate of change is required, what level of risk the system is willing to anticipate, how to put boundaries around it, and how we bring together the parties in order to create innovation, because neither the regulator, the bank, or the tech companies alone have all of the skills required to do this. So we've got a key set of skills and assets in the technology and data we provide to solve the problem, but we don't have some of the other skills. So we're not experts in regulation, we're not experts in banking products or banking. So it does need to be a collaborative effort, and that glue to pull all this together, I think, still hasn't appeared yet. So there is a hole where there's some leadership needed, whether that be policy, regulatory, commercial, or otherwise. That's kind of the market we're sort of leaning into. We're trying to drive thought leadership in this area and trying to stimulate other actors who can have more influence on the sort of joined up solutions and thinking to come together and actually help the industry to come up with the key tenets of how to drive change and reinvention of working capital so that it is more inclusive for those smaller companies.
It's really interesting, this. I mean, would you say there's enough outreach and engagement from the regulators? This isn't just this is a common problem, isn't it? Where it almost feels like the balance has gone too far in favor of market stability at the cost of innovation and potential, and in terms of kind of growth potential. And there isn't enough collaboration and outreach and engagement with all the parties. That point around skills, everybody has some skills, but not all the skills, is coming up a lot, particularly around tech and digital, kind of unsurprisingly, really. But is enough engagement, or should the regulators be doing a lot more of it?
It's a good question. Regulators only have part of the skills as well. So creating those programs of change is probably not in sort of their core skill set. So again, I don't think it's a lack of desire to create a better framework for outreach. I think it's a lack of understanding of how to do that, and a lack of sort of resourcing, and thinking about different skills required to pull all of that together. In some ways, I think we need to look for solutions outside of financial services, and that's one of the reasons why I wanted to get involved in the sector in the first place, because typically where you see revolutionary breakthrough in terms of new types of thinking and solution, it's adopting sort of techniques and practices that have happened in other industries. Coming from the tech industry, we've got more familiarity with some of the missing components within financial services, but we also don't have a good enough understanding of some aspects of banking to necessarily be able to land those points with some of the more seasoned leaders in the sector or in sort of policymakers. So like everybody else, I'm not 100% sure what the solution needs to be, but there does need to be sort of an overarching framework which the regulator can contribute to, the banks can contribute to, and the tech companies can contribute to. And it needs to focus much more around what are the needs of growth companies. And I keep using the word growth companies because they're different than the shape of large corporates. I mean, large corporates optimize their balance sheet and their P&L statements, and they have specific requirements and tools to do that. Growth companies look to consume as much resource as possible in order to accelerate the evolution of a new market or the creation of a new proposition. And often they're not profitable, or they choose to make very little profit in order to be able to continue to feed the accelerated rate of growth. And that doesn't really work in terms of aligning with a lot of the working capital solutions or indeed other banking products today. So there needs to be some thinking around how we can actually address those companies. And the reason why I think it's important is that's where change will come from. Large companies will continue to do pretty much what they do because they've got a vested interest in continuing that, and they've got an obligation to their shareholders in order to make sure that they are responsible stewards for the capital that's been invested. Whereas there's more appetite and flexibility for growth companies, either small companies or mid-market companies, in order to drive change. And often they have better skills to do that as well. They also have more digital data. Their systems tend to be more cloud native. It's just not the type of data that the banks are used to seeing or the regulators used to dealing with. But you can actually tell a lot more about what's going on operationally, risk-wise, and sort of market traction-wise with smaller companies than you can with big companies, because you can actually access most of the data digitally. So there's definitely assets there which are underutilized. And if we were to think sort of holistically across the industry about how best to utilize those assets, I'm sure we could come up with a reinvention of the concept of working capital for those types of growth category companies.
Yeah, this is a really relevant conversation. It kind of leads me to my next question is, okay, so no one has quite got the skills. Everyone has something to contribute. There's clearly a big opportunity here. Who's the convener of this work? Who brings the parties together? Is that government? Is it the regulators? Is it the industry? Is it organizations like the International Chamber of Commerce?
So my view is it needs to be an industry lobby or a commercially led initiative that sort of goes to government and regulators. I wouldn't say it demands, but outlines what is required. What is the space and the change in regulations or the constraints that need to be relaxed under what conditions in order for this to happen. So from our perspective, the most impact we can have is working with our customers. And you can see we made a press release this month about the work we're doing with Barclays, which I think is a good example of how sort of commercial sort of innovation can happen when you get a small sort of technology company doing sort of innovation's a relative term, because in tech terms, there's nothing sort of experimental about what we're doing. We're just applying new modern sort of enterprise technology to an existing problem. But essentially, we're digitizing and automating a specific set of products. And the idea is to do one product after another and do them end to end. And that level of innovation we're doing, it's sort of within us as a vendor to a supplier of a large bank, being Barclays. But what we'd like to do is actually find a way to have that conversation at an industry level so we can drive change quicker, and more of those types of initiatives can be connected up so that there's a clear direction as to what will add value faster. Because if we keep going the way we're going, I'll be long retired before we get anywhere near the 5 to 10 trillion of additional sort of working capital flowing into the market that is required. And that's by 2030. I'm hoping by 2030, my job here will be done. So we're keen to find out how to bring that together. I think the ICC can play a really interesting role as an industry body. And I think there are 3 or 4 other interesting bodies as well that can do that. Where the problem has been in the past is something I mentioned earlier, which is if you ask particular industry participant, they're going to answer from their viewpoint, and their viewpoint will be connected to their day job. So it's understanding, what the rate of innovation is that you're looking for, how radical a change you're looking at, and what rate of change is actually possible. Because banks will necessarily change slowly, because that's what regulation is there for, is to make sure that there's no systemic shocks which come from change happening too fast, which kind of rubs against the need for this type of initiative.
Yeah, this is really interesting. It's obviously a longer conversation, this, isn't it? We've got some good opportunities, I'm thinking, coming up as well. Conversations with government and industry bodies is something that we should definitely pick up. So just to sort of finish off, I mean, what does success look like for you? If you were to imagine that, you've mentioned the word 2030, what would you see as success by 2030? What do we need to do, or have done by then, I should say?
So for me, we've got a very clear purpose. Start where I finish. I mean, we really want to try and be part of the solution to unblock another $5 trillion USD of capital flowing into growth companies. That's generally mostly either mid-market or small companies, but it can be large corporate as well. We're not fussy about how we sort of unblock the drain, as it were. The success for us looks like seeing large volumes of capital which wouldn't otherwise have gotten deployed in market to help with economic growth and change. So most of the big problems that we have in society, whether it be environmental issues with discrimination, gender inequality, etc., these things can only be changed if we actually find a framework to deploy resources in order to tackle them at scale. And in my mind, the best mechanism we have to do that is businesses. I mean, businesses by their nature and their charter are there to actually have an impact to deliver something. And most of the world's resources are actually deployed in one way or another through some type of business or organization. So being able to sort of rebalance the flow of working capital into companies run by people who want to have an impact on these issues is what success looks like for me. So rather than having to take a left turn out of commercial endeavors and look at philanthropic endeavors and charitable efforts in order to solve these problems, we need to make business more of a power for good in the organization, because it is so powerful. It consumes so much resource, and these problems shouldn't be a side of desk issue once you've done your day job. These should become part of your day job. And the only way we can do that is by how we direct resources and capital. Innovation happens where capital flows. And our purpose and what success looks like is to try and make sure that we can divert some of the flow of the capital, or increase the flow of capital, so it actually can include more of these growth companies with more of a capacity to have an impact and change on these issues.
Well, thank you very much, Martin. It's been a pleasure listening to you as always. And thank you to our listeners as well for their time. We've probably run a little bit over, but I think this is such an interesting and relevant topic that it deserves a lot more airtime. So thanks very much, Martin. It's been a pleasure.
Thanks for the invite, Chris. I've enjoyed the conversation also.